Hello traders. Welcome back. Today we will go over knowing when to buy or sell a currency pair. Forex trading involves trying to predict which currency will rise or fall versus another currency. How do you know when to buy or sell a currency pair? In the following examples, we are going to use a little fundamental analysis to help us decide whether to buy or sell a specific currency pair. The supply and demand for a currency changes due to various economic factors, which drive currency exchange rates up and down. Each currency belongs to a country or region. So Forex fundamental analysis focuses on the overall state of the country's economy, such as productivity, employment, manufacturing, international trade, and interest rates. Our first example will be the Euro USD. In this example, the euro is the base currency and thus the basis for the buy, sell. If you believe that the US economy will continue to weaken, which is bad for the US dollar, you would execute a buy a Euro USD order. By doing so, you have bought euros with the expectation that it will rise versus the US dollar. If you believe that the US economy is strong and the euro will weaken against the US dollar, you would execute a sell Euro USD order. By doing so, you have sold euros with the expectation that it will fall versus the US dollar. Now, let's try USD, JPY. In this example, the US dollar is the base currency and thus the basis for the buy, sell. If you think that the Japanese government is going to weaken the yen in order to help its export industry, you would execute a buy USD, JPY order. By doing so you have bought US dollars with the expectation that it will rise versus the Japanese yen. If you believe that Japanese investors are pulling money out of US financial markets and converting all their US dollars back to yen, and this will hurt the US dollar, you would execute a sell USD, JPY order. By doing so you have sold US dollars with the expectation that they will depreciate against the Japanese yen. Let's try this one together. GBP, USD. In this example, the pound is the base currency and thus the basis for the buy, sell. If you think the British economy will continue to do better than the US in terms of economic growth, you would execute a buy GBP, USD order. By doing so you have bought pounds with the expectation that it will rise versus the US dollar. If you believe the British economy is slowing while the American economy remains strong, you would execute a sell GBP, USD order. By doing so you have sold pounds with the expectation that it will depreciate against the US dollar. Now for our last example, USD, CHF. In this example, the US dollar is the base currency and thus the basis for the buy, sell. If you think the Swiss franc is overvalued, you would execute a buy USD, CHF order. By doing so you have bought US dollars in the expectation that it will appreciate versus the Swiss franc. If you believe that the US housing market weakness will hurt future economic growth, which will weaken the dollar, you would execute a sell USD, CHF order. By doing so, you have sold US dollars with the expectation that it will depreciate against the Swiss franc. Now let's go over trading in lots. When you go to the grocery store and want to buy an egg, you can't just buy a single egg, they come in dozens or lots of 12. In Forex, it would be just as foolish to buy or sell 1 euro, so they usually come in lots of 1,000 units of currency, micro lot, 10,000 units, mini lot, or 100,000 units, standard lot. Depending on your broker and the type of account you have, more on lots later. Next up is margin trading. You might be thinking, but I don't have enough money to buy 10,000 euros. Can I still trade? You can, by using leverage. When you trade with leverage, you wouldn't need to pay the 10,000 euros up front. Instead, you'd put down a small deposit, known as margin. Leverage is the ratio of the transaction size or position size to the actual cash or trading capital used for margin. For example, 50-to-1 leverage, also known as a 2% margin requirement, means $2,000 of margin is required to open a position size worth $100,000. Margin trading lets you open large position sizes using only a fraction of the capital you'd normally need. This is how you're able to open $1,250 or $50,000 positions with as little as $25 or $1,000. You can conduct relatively large transactions with a small amount of initial capital. Let me explain how. I will go over margin in more detail later, but hopefully, you're able to get a basic idea of how it works for now. So listen carefully because this is very important. So let's say you believe that signals in the market are indicating that the British pound will go up against the US dollar. You open one standard lot, which is 100,000 units of GBP, USD, buying with the British pound with a 2% margin requirement. Then, you wait for the exchange rate to climb. When you buy one lot, which is 100,000 units of GBP, USD at a price of 1.50000, you are buying 100,000 pounds, which is worth $150,000, from multiplying 100,000 units of GBP by 1.50000. Since the margin requirement was 2%, then 3,000 United States dollars would be set aside in your account to open up the trade, from $150,000 times 2%. You now control 100,000 pounds with just $3,000. Your predictions come true and you decide to sell. You close the position at 1.50500. You earn about $500. When you decide to close a position, the deposit or margin that you originally made is returned to you and a calculation of your profits or losses is done. This profit or loss is then credited to your account. Let's review the GBP USD trade example above. GBP USD went up by a mere half a pence. Not even 1 pence. It was half a pence. But you made $500 while taking a power nap. How? Because you weren't trading just 1 pound. If your position size was 1 pound, yes, you would have made only half a pence. But your position size was 100,000 pounds, or $150,000, when you opened the trade. What's neat is that you didn't have to put up that entire amount. All that was required to open the trade was $3,000 in margin. $500 profit from $3,000 in capital is a 16.67% return. In 20 minutes. That's the power of leveraged trading. A small margin deposit can lead to large losses as well as gains. It also means that a relatively small movement can lead to a proportionately much larger movement in the size of any loss or profit, which can work against you as well as for you. You could have easily lost $500 in 20 minutes as well. You wouldn't have woken up from a nightmare. You would have woken up into a nightmare. High leverage sounds awesome, but it can be deadly. For example, you open a Forex trading account with a small deposit of $1,000. Your broker offers 100-to-1 leverage, so you open €100,000 per USD position. A move of just 100 pips will bring your account to $0. A 100 pip move is equivalent to €1. You blew your account with a price move of a single euro. Now let's go over rollover. For positions open at your broker's cutoff time, usually 5 p.m. Eastern Time, there is a daily rollover fee, also known as a swap fee, that a trader either pays or earns, depending on the positions you have open. If you do not want to earn or pay interest on your positions, simply make sure they are all closed before 5 p.m. Eastern Time, the established end of the market day. Since every currency trade involves borrowing one currency to buy another, interest rollover charges are part of Forex trading. Interest is paid on the currency that is borrowed. Interest is earned on the one that is bought. If you were buying a currency with a higher interest rate than the one you are borrowing, then the net interest rate differential will be positive, for example, USD, JPY, and you will earn interest as a result. Conversely, if the interest rate differential is negative, then you will have to pay. Note that many retail Forex brokers do adjust their rollover rates based on different factors, like account leverage and interbank lending rates. Please check with your broker for more information on their specific rollover rates and debiting procedures. Here is a table to help you figure out the interest rate differentials of the major currencies. These interest rates are used by the country's central banking institution to lend short-term money to the country's commercial banks. Later on, I'll teach you all about how you can use interest rate differentials to your advantage. If you enjoyed this video, hit that thumbs up button, subscribe to our channel for more entertaining trading content, and of course share it with your friends. Adios, till next time.